So, um, usually when we look at a phenomenal business on this show, there's this moment of like physical clarity.
Right, like a tactile understanding.
Exactly. You can literally reach out and touch the reason the company makes money. Think about the Visa test.
Oh, I love the Visa test. It's so clean.
It is. If you want to understand Visa, all you have to do is take your credit card out, go to a local coffee shop, and swipe it to buy a latte. In the, I don't know, 15 seconds it takes for that transaction to clear.
You completely grasp how they make their money.
Yeah, you get it instantly. It's a toll booth on every single swipe. The product meets the customer meets the business, and you, as the investor, understand the entire transaction.
That visibility is just incredibly comforting. You don't need a degree in cryptography to understand that Visa just sits right in the middle of the global economy, lifts the barrier, lets the money through, and takes a fraction of a cent.
Right. It takes 15 seconds to comprehend the core economic engine. But the moment you step into the world of our deep dive today, that clean 15-second Visa test just shatters. It breaks completely.
Yeah, into a million pieces.
You are suddenly looking at a product that almost no ordinary investor will ever physically see, performing mathematics they cannot comprehend for customers they do not even know.
And that massive gap in understanding, that blind spot, is exactly why we pulled together today's stack of sources.
Which is an extensive stack, by the way.
Oh, absolutely massive. We are digesting everything from MIT's 2025 research papers on AI return on investment to highly technical breakdowns of Google's custom chip architecture.
Not to mention the granular supply chain logistics reports out of Taiwan.
Right. Because our mission today is to give you the analytical tools to sit directly inside that gap in understanding. We're not going to read a tech manual and pretend we're semiconductor engineers.
No, definitely not.
But we are going to explore the absolute limits of what an ordinary investor can actually know about the most valuable business on planet Earth.
Welcome to episode 5 of our S&P 500 series, focusing on NVIDIA, ticker symbol, NVDA. A company that hit a staggering $5.0 trillion market cap in mid-2026.
Which is just a number that's hard to even wrap your head around.
It really is. And because we're tackling a company of this sheer magnitude, we need to weave our mandatory disclaimers right into the foundation of this deep dive.
Do not skip this part, please.
Right, I want to speak directly to you listening right now. This deep dive is strictly for educational purposes. We are not financial advisors, and this is absolutely not investment advice.
Zero investment advice.
You will not hear a single price target from us today.
Yeah.
We are making no recommendations to buy, sell, or hold NVIDIA or any other equity we mention.
Yeah, instead of handing you a predefined answer, we want to hand you the raw materials to build your own model.
Which is so much more valuable.
Exactly. If you look in the description of this deep dive right now, you will find a comprehensive written brief, a fully interactive valuation tool, and a downloadable Excel file packed with historical financial data going all the way back to 2010.
So please tap those links. We highly encourage you to pull those tools up, put in your own assumptions, and run the math yourself.
Run your own numbers.
Because by the end of this deep dive, we're going to ask you one critical question that you will have to answer by looking yourself in the mirror.
The mirror test.
Yeah. And if you cannot answer it, you probably shouldn't own this stock. So to get you to that point, the spine of our analysis today is going to rely on the frameworks of two of the most legendary investors in history.
Warren Buffett and Peter Lynch.
Right. We're going to look at NVIDIA through Buffett's obsession with moats and his circle of competence.
And then we'll apply Peter Lynch's classic 10-year-old test, along with his favorite valuation metric, the PEG ratio.
And the ultimate contradiction, the ultimate tease that we'll be returning to throughout this whole hour is that if you apply the strictest interpretations of both Buffett and Lynch to NVIDIA today, they would both likely pass on the investment.
Which sounds crazy, right, given the numbers?
It does. Despite the company possessing the fastest growth and highest margins in a generation, the fact that the product never meets the end customer creates a blind spot that traditional value investors just cannot tolerate.
So let's attack that blind spot directly. We have to start with the physical product.
Right. What does NVIDIA actually sell? How did a company that used to make graphics cards for teenagers playing video games become the absolute engine of global artificial intelligence?
Well, at the foundational level, NVIDIA designs graphics processing units, or GPUs. And to understand how a video game chip became an AI engine, we really need to explore the architectural difference between a traditional computer chip, a CPU, and a GPU.
Okay, let's use an analogy to ground the physics here. A traditional CPU, a central processing unit, is fundamentally a sequential processor. I think of it like a brilliant mathematics professor.
Okay, I like this.
You hand this professor an incredibly complex, multi-step calculus problem, and they will solve it faster than anyone else on Earth. But they solve things linearly.
One incredibly hard problem at a time.
Exactly. The CPU runs your computer's operating system, it manages file transfers, it does complex logic in a strict order.
But the GPU architecture flips that entirely. So if the CPU is the brilliant professor, the GPU is a stadium filled with 50,000 ordinary middle schoolers.
50,000 middle schoolers? That sounds terrifying.
It is. And none of those middle schoolers can calculate advanced sequential calculus. But if you give every single one of them a very simple arithmetic problem like, what's 3 times 4? Or adjust the color of this single pixel.
They can all shout out the answer at the exact same fraction of a second.
Exactly. The GPU excels at parallel computing. It performs millions of tiny, simple math problems simultaneously.
Which, ironically, is exactly the mechanic required to render a 3D video game.
Right.
Because the computer has to calculate the geometry, the lighting, the color of millions of individual pixels on your monitor, like 60 times a second.
That's not one hard math problem.
No, it's a mountain of simple math done all at once.
And the profound accident of modern business history is that training an artificial intelligence model, specifically the large language models behind platforms like ChatGPT, requires the exact same kind of math.
It's unbelievable. Teaching a neural network to understand language does not require deep sequential calculus.
Nope. It requires taking terabytes of text data and performing trillions of tiny parallel matrix multiplications to adjust the weights and biases of the network.
So the math required to render a digital dragon in a video game happens to be the exact same math required to teach a machine how to speak English.
It's wild. But that structural reality triggers Peter Lynch's famous rule, right? The 10-year-old test.
Oh man, the 10-year-old test. Lynch argued that you should be able to explain your thesis for owning a stock to a 10-year-old in under 2 minutes.
Let's do it. Let's role play this for just a few seconds on air. I'll play the 10-year-old, you play the investor. Ready? Go.
Okay.
You just bought a stock. What does the company do?
NVIDIA makes a special kind of computer chip that helps draw video games really fast.
Cool, I play games. But why is it the most valuable company in the whole world?
Well, because the same chips are needed for AI, which is software that learns by doing trillions of tiny math problems all at once.
How does software do math without being told what the answer is?
Well, it uses parallel computing to run neural networks through a process called training, which adjusts probability weights.
Time. The test is already falling apart.
Oh my God, I failed it in less than 30 seconds. I'm completely buried in jargon. I mean, I'm trying to explain parallel processing, neural networks, inference versus training, probability matrices to a child.
You fail the test instantly. And failing that test is not just a parlor trick. It is the loudest possible signal an investor can receive.
It proves that the business mechanics sit entirely outside your circle of competence.
Right. When Peter Lynch demands a 2-minute explanation, he's testing your grasp of causality. With Visa, the causality is transparent. Plastic card swiped, a penny collected.
With NVIDIA, the moment you hand-wave past parallel computing, you completely lose the ability to evaluate the core product.
And if we elevate this from a 10-year-old's level to, like, an adult institutional level, the complexity just gets worse. To truly grasp why NVIDIA is dominant, you have to understand the unit economics of what you just mentioned. Inference versus training.
Yeah, let's unpack that because it's vital.
It's a huge distinction. Training is the process of building the AI model. You feed the GPU clusters massive mountains of data over months to form the neural pathways. It requires immense brute force computational power.
Building the brain, basically.
Exactly. Inference is what happens after the model is built, when a user actually types a prompt into ChatGPT and the model generates an answer.
So training is building the brain, inference is using the brain.
Yes. And NVIDIA currently dominates both, but the hardware requirements and the competitive pressures for those two distinct phases are wildly different.
So if you, as an investor, cannot differentiate between the physics of training a model and the economics of running inference, how can you possibly evaluate if a competitor has built a better chip?
You can't. You simply cannot. You are buying a headline, not an understood cash flow.
But investors willingly overlook that blind spot because the financial metrics are so hypnotic.
Oh, the numbers are staggering. But before we dissect those numbers, we absolutely must issue a massive structural warning about NVIDIA's corporate calendar.
Yes. Do not skip this. This is a vital trap that skews almost every amateur financial model out there.
If you pull up the financial statements, you will frequently see references to NVIDIA's fiscal 2025 earnings.
And the human brain automatically assumes that covers the calendar year coming 25, right?
Yeah.
January through December.
But it does not. NVIDIA's fiscal calendar is shifted. Fiscal 2025 actually refers to the 12-month period that ended on January 26, 2025.
Wait, so it covers February of 2024 through the end of January 2025?
Correct. The label and the actual calendar disagree by 11 whole months.
That's a massive discrepancy. If you take NVIDIA's fiscal 2025 numbers and compare them side by side with Microsoft's or Google's calendar year 2025 projections.
Yep. You are comparing two completely different slices of time. In the hyper-accelerated AI arms race, an 11-month lag is the difference between two totally different financial realities.
Okay, so with that calendar alignment locked in, let's track the sheer velocity of the revenue explosion.
It's unprecedented.
In fiscal 2023, NVIDIA generated $27 billion in revenue. By fiscal 2024, that rocketed to almost $61 billion.
Which is insane growth.
Right, but then in fiscal 2025, the year ending January 2025 revenue hit $130.5 billion.
And estimates for fiscal 2026 sit at roughly $216 billion.
Scaling a hardware company from $27 billion to over $200 billion in roughly 3 years defies industrial gravity.
It does. But the top-line revenue is only half the story. The profitability metrics are what truly break financial models. NVIDIA's gross margin has hovered around 73%.
73%. Let's break down the mechanics of why that number is so abnormal in plain English.
Okay, so gross margin measures what it costs to physically deliver the product compared to the revenue it generates. NVIDIA operates on a fabless or asset-light model.
Meaning they don't actually build the chips themselves.
Right. They do not own the massive multi-billion-dollar factories called fabs that actually print the microscopic transistors onto silicon wafers. They buy that raw manufacturing capacity from TSMC in Taiwan.
So NVIDIA performs the brilliant architectural design work, packages the chip with proprietary software, and sells it.
Exactly. So a 73% gross margin means that for every dollar NVIDIA collects from a hyperscale customer like Meta or Microsoft, the direct cost to physically manufacture that chip is only about 27 cents.
They retain 73 cents of pure gross profit on physical metal and silicon.
It's unheard of. In the hardware sector, which is notoriously capital-intensive and brutally competitive, a 73% margin is a total anomaly. It's the single clearest financial fingerprint of immense pricing power.
It essentially signals that customers are so desperate for this specific architecture that no competitor can offer a cheaper alternative that performs well enough to force NVIDIA to lower their prices.
Right. And that gross margin then feeds into their operating margin, which sits at roughly 60%.
Wow. Which introduces the concept of operating leverage. Right.
Yes. Designing a new chip, like the Blackwell or the H100, requires an immense upfront investment in R&D. You're paying billions to the most brilliant semiconductor engineers on Earth.
But once the architecture is finalized, that cost is basically sunk.
Exactly. When demand explodes and you suddenly sell $70 billion more of that exact same chip architecture, your engineering payroll does not magically double.
Your administrative overhead doesn't double.
No. Those fixed operating costs remain relatively flat, meaning a massive percentage of that new revenue bypasses the expense lines and falls straight to the bottom line as pure net income.
Operating leverage is what allowed their net income to grow significantly faster than even their top-line revenue during the scale-up.
However, and this is a big however, presenting those metrics in isolation paints a picture of a flawless, invincible machine, a chart that simply goes up and to the right into infinity.
And that is a dangerous narrative. We must aggressively push back on the up-only assumption by examining the cyclical history of the hardware business.
We cannot skip over the reality of fiscal 2023.
Right. So look at the historical data in the Excel file we link in the description. In fiscal 2022, NVIDIA produced almost $10 billion in net income.
A great year.
But just 12 months later, in fiscal 2023, net income collapsed to $4.4 billion. Earnings plummeted 56% in a single year.
More than half.
How does a monopoly with a 73% gross margin lose more than half its earnings power that quickly?
That crash is the ultimate reminder that NVIDIA is not a recurring revenue software business collecting predictable monthly subscriptions. It is a highly cyclical hardware vendor, heavily dependent on the capital expenditure budgets of its clients.
So what exactly happened in 2023?
Well, the fiscal 2023 crash was driven by a violent bust in the cryptocurrency mining market, compounded by a massive glut of excess video game inventory following the pandemic boom.
So demand evaporated, the secondary market was flooded with used GPUs, and NVIDIA was forced to take massive inventory write-downs.
Exactly. A chart pointing to the sky today is hiding a business architecture capable of incredibly violent downturns. Extrapolating a straight line upward ignores the fundamental physics of capital expenditure cycles.
Which brings us directly to the Warren Buffett framework. Those 73% margins absolutely prove that NVIDIA possesses a moat today. But Buffett demands to know the structural depth of that moat, and most importantly, who is actively trying to cross it.
Right. The true competitive advantage is not just the physical silicon.
Because if hardware advantages were the only moat, a competitor could simply hire brilliant engineers, spend billions of dollars, and build a slightly faster processor next year.
The actual lock-in mechanism is the software layer. We have to unpack the mechanics of CDA.
Okay, CDA, spell it out for us in plain English.
CDA is an application programming interface, or API, that NVIDIA introduced over 15 years ago. Before CDA, forcing a GPU to do general-purpose parallel math was a nightmare.
Programmers had to essentially trick the graphics hardware by writing code that pretended to be rendering pixels.
Yeah, it was super clunky. So NVIDIA recognized this friction and built a software platform that allowed developers to use standard programming languages like C++A to send instructions directly to the GPU cores.
And they spent a decade and a half building out specialized libraries of code for every imaginable mathematical function.
Yes. So if a data scientist wants to run a complex matrix multiplication for a neural network today, they don't have to understand the microscopic voltages of the silicon. They just pull a pre-written CUD library command.
And as a result, virtually every AI researcher, academic institution, and enterprise data scientist has spent the last 15 years writing their foundational models in CUD.
It became the default language of artificial intelligence. Moving to a rival chip built by AMD or Intel does not just require buying different hardware.
It requires rewriting, translating, optimizing, and debugging years of incredibly complex AI software to function on an entirely different platform.
That is a switching cost moat of the highest order.
So even if a competitor designs a chip that is, say, 15% faster and 20% cheaper, the customer will refuse to switch because the labor cost and operational risk of rewriting their software stack vastly outweighs the hardware savings.
It sounds impenetrable, but we have to stress test that moat using a framework popularized by Pat Dorsey, known as the $10 billion challenge.
I love this thought experiment. The premise is simple. If I handed you $10 billion in cash and allowed you to hire the absolute best engineering talent on Earth, could you steal this company's market share?
Against a random Silicon Valley startup, NVIDIA's moat easily repels the $10 billion. You cannot replicate 15 years of entrenched developer habits with a single funding round.
Right. But the nuance here is deeply uncomfortable. The $10 billion test brings a massive leak when we identify NVIDIA's actual customer base.
Yeah. NVIDIA's revenue is heavily concentrated among the 4 hyperscalers: Google, Amazon, Meta, and Microsoft.
And these entities do not have $10 billion. They have hundreds of billions in free cash flow.
They possess the world's most elite engineering talent. They are the $10 billion challenge made flesh.
And crucially, they are highly motivated to shatter NVIDIA's moat because they resent paying a 73% gross margin. They want to internalize that profit.
The very companies responsible for buying 90% of the product are the exact same entities building the siege engines outside the castle walls.
That dynamic creates an environment of perpetual vulnerability.
Which naturally leads an investor to ask, if the financials are currently flawless, why does understanding the technical vulnerability of the moat actually matter?
Yeah, if the chart is going up, why do I need to care about the intricacies of API switching costs or custom silicon?
Well, we received a brutal historic answer to that exact question on January 27, 2025.
DeepSeek Day. This event is the ultimate case study in the cost of ignorance. On that single trading day, NVIDIA's stock price collapsed by roughly 17%.
Plummeted.
That drop incinerated approximately $593 billion of market value in a matter of hours, the biggest single-day loss in market history.
It's hard to fathom. Nearly $600 billion is the equivalent of wiping out the entire GDP of a mid-sized nation, or completely vaporizing the market capitalization of multiple major Fortune 500 corporations, all between breakfast and lunch.
And the catalyst for this historic collapse was not a terrible earnings report. It
Yeah.
was not a factory burning down. The catalyst came from an AI startup in China called DeepSeek.
They released a new frontier language model and claimed it achieved performance parity with the top-tier models from OpenAI and Anthropic.
And this is where the causal chain becomes essential to map out. Because DeepSeek is an app on your phone, right?
Right.
They build a chatbot. They do not manufacture physical semiconductors.
No, they're a software company.
So why did a software company launching an app trigger a $500 billion crash in a hardware manufacturer?
The shockwave wasn't driven by how intelligent the DeepSeek model was. It was driven by how they claimed to have built it.
Ah, right.
DeepSeek published a technical paper stating they trained this frontier model for under $6 million, utilizing a relatively small cluster of older, less powerful chips.
They bypassed the need for massive raw compute power through algorithmic breakthroughs.
Exactly. We need to explain the mechanics of those algorithmic breakthroughs, specifically concepts like mixture of experts and low-precision math.
Let's do it. What is mixture of experts?
So DeepSeek heavily utilized this architecture, Moat.
Yeah.
In a standard, dense neural network, every single parameter, all the billions of artificial neurons, must be activated to answer a prompt, consuming massive amounts of electricity and compute time.
Right. The whole brain lights up.
But in a mixture of experts model, the network acts like a sorting facility. It analyzes the prompt and only activates a small, specialized subsection of the network, maybe 10% of the parameters, to generate the answer.
So you get the intelligence of a massive model while only burning the compute power of a tiny one.
Precisely. And they combine that with FP8, or low-precision math. Instead of forcing the GPU to calculate probabilities out to a massive number of decimal places, they realized the neural network could still learn effectively using much shorter, less precise numbers.
Which takes significantly less memory and time to process.
These technical realities form a hidden chain of logic that only an informed owner of the business could see.
Let's walk through that chain.
Step 1. DeepSeek proves state-of-the-art AI can be trained with drastically less computing power using MoE and low-precision algorithms.
Step 2. If the industry adopts these highly efficient techniques, the standard cost and hardware required to train a model plummets.
Step 3. Google, Meta, and Microsoft realize they no longer need to purchase clusters of 100,000 top-tier GPUs for their next generation of models.
Step 4. Future volume demand for NVIDIA hardware drops significantly.
And step 5. Institutional models immediately downward revise NVIDIA's terminal growth rates, and the stock violently reprices to reflect that suddenly constrained future.
Understanding that 5-step causal chain highlights the psychological difference between a chart buyer and an owner.
Oh, this is crucial. The chart buyer purchased NVIDIA solely because the price action was positive. They have no concept of mixture of experts or CEDIA.
So on January 27, they wake up to a 17% portfolio drawdown and a confusing headline about a Chinese software app.
Right, and lacking any analytical framework to evaluate the news, their only available responses are panic and fear. They become a hostage to the emotional state of the broader market, outsourcing their risk management to the crowd.
Conversely, the owner who has done the foundational research experiences the exact same 17% drop. But instead of blind panic, they possess a specific evaluated question. Are DeepSeek's algorithmic efficiency claims actually repeatable at scale across different modalities?
They can actually read the technical white papers. They can assess whether DeepSeek's methods represent a permanent structural shift in AI physics or simply an impressive one-off optimization trick.
And over the subsequent weeks, the broader market began to digest the technical limitations of DeepSeek's approach, realizing that while inference was optimized, the total compute required for next-generation multimodal AI was still expanding.
The stock recovered significantly. The informed owner recognized the panic as an exaggerated mispricing of the moat, converting a terrifying drop into an evaluated opportunity.
The financial metrics might get you into a stock, but fundamental understanding is the only thing that preserves your rationality when the market loses its mind.
Exactly. But DeepSeek represented a theoretical threat to the training side of the equation. There is a much more severe existential risk developing on the demand side.
The demand side, okay, let's pivot to this because the entire multi-trillion-dollar valuation of NVIDIA rests on a single foundational assumption.
Yet, the hyperscalers will continue authorizing tens of billions of dollars in capital expenditure for data centers every single quarter.
Right. And those cloud providers are only purchasing the chips because their enterprise clients, the Fortune 500 banks, logistics networks, and healthcare systems, are paying them massive premiums to rent AI compute capacity.
So NVIDIA's valuation assumes that these end users are actually generating tangible profits from deploying AI.
Which brings us to the structural bear case.
Yep.
We have to examine the data regarding end-user return on investment, or ROI.
This is where it gets scary. In 2025, researchers from MIT's NANDA initiative published a comprehensive analysis of corporate generative AI pilot programs. The findings were exceptionally sobering.
Sobering is an understatement. Roughly 95% of enterprise generative AI pilots demonstrated zero measurable return on investment.
95%.
95% failed to prove they made the company money. Now, to maintain absolute analytical objectivity, the MIT authors noted that many of these failures stemmed from poor internal implementation, siloed corporate data, and unrealistic management expectations.
Right. It wasn't necessarily that the AI models themselves lacked utility.
But the financial outcome is identical regardless of who is to blame. Enterprises allocated capital to rent NVIDIA-powered compute, and 95% of the time, the profit margins did not expand.
And we can connect this academic data to real-world friction using the unit economics of AI inference. Why is the ROI missing? It comes down to the physical cost of generating an answer.
Exactly. When a company buys a traditional software as a service subscription, the marginal cost for the software provider to serve one more user is essentially zero. It's just copying and pasting code.
But every single time an employee queries a generative AI model, it physically forces a GPU in a data center to perform trillions of calculations, consuming massive amounts of electricity and compute time.
The cost scales linearly with usage.
Yes. So if a logistics company deploys an AI agent to replace a human customer service representative who costs $20 an hour, but the API calls required for the AI to process the complex routing queries burn $25 an hour in pure compute costs.
The operational efficiency is entirely destroyed. The AI might be brilliant, but the unit economics are structurally negative.
And we saw this exact friction materialize at the highest levels of the tech industry. Early in 2026, reports surfaced regarding Uber's internal AI deployment.
Oh, this is a massive reality check.
Uber is a highly sophisticated, data-driven organization utilizing AI for dynamic pricing and routing optimization. Yet they burned through their entire allocated AI compute budget for the year 2026 in just 4 months.
4 months. And they did not abandon the AI because the output was poor. They were forced to ration API calls because the sheer operational expense of the compute was eroding the profit margins of the very efficiencies the AI was designed to create.
We even have an explicit acknowledgement of this dynamic from inside the ecosystem. An NVIDIA vice president went on the record stating, and this is a direct quote, "The cost of compute far exceeds the cost of employees."
That quote is the fragile hinge of the entire growth narrative. Corporations are currently tolerating these negative unit economics as a defensive posture. They are terrified of falling behind competitors.
They're placing a massive corporate bet that the cost of compute will eventually decline while model intelligence increases.
But if that corporate bet sours, we can map out the precise domino effect of demand destruction.
Step 1. Chief financial officers across the Fortune 500 observe the MIT data in their own internal audits. They realize the AI pilots are draining cash flow without replacing headcount or driving net new revenue.
Step 2. The CFO issues a mandate, exactly like the reality check at Uber. Internal tech teams are placed on strict compute rations. They are forced to utilize smaller, cheaper, open-source models for basic tasks, drastically reducing their reliance on massive frontier models.
Step 3. The hyperscalers Amazon AWS, Microsoft Azure, Google Cloud register a sudden plateau or sequential decline in the hourly rental usage of their top-tier GPU instances.
Their massive data centers are suddenly running at 70% capacity instead of 100%.
Step 4. Recognizing the softening end-user demand, the cloud giants immediately pause their facility expansions. They inform NVIDIA that they do not require 100,000 new chips next quarter. They only need 30,000 to cover replacement cycles.
And then step 5. NVIDIA releases a quarterly earnings report featuring a catastrophic miss on forward revenue guidance. The narrative of flawless exponential growth shatters.
The market violently reprices the valuation multiple downward to reflect a mature cyclical business rather than an infinite growth engine.
Demand can recede just as violently as it arrived, if the end-user ROI does not mathematically justify the capital expenditure.
And look, as end-user demand softens, the cloud giants will face immense pressure from their own shareholders to protect their profit margins. This circles us back to the threat of internal competition.
Right. To lower the cost of inference and improve the unit economics for their clients, the hyperscalers are aggressively deploying their own custom-built silicon.
We are talking about Google's Tensor Processing Unit, or TPU, Amazon's Trainium, and Meta's MTIA. We need to explain why these custom chips are structurally cheaper to operate than a general-purpose NVIDIA GPU.
It really comes down to architectural specialization. An NVIDIA GPU is a generalist. It is engineered to perform exceptionally well across a wide variety of tasks, rendering high-end video game graphics, mining cryptocurrency, training massive neural networks, and running inference.
But because it has to be capable of everything, it carries a lot of complex hardware that isn't strictly necessary for every single job.
Right. Now contrast that with a custom chip like a TPU. It's an application-specific integrated circuit, or ASIC.
Google engineered the TPU specifically to run the matrix multiplications required for AI. They ripped out all the dead weight, the hardware dedicated to graphics rendering and legacy compatibility.
So by stripping the chip down to its absolute essentials, it runs physically cooler, consumes significantly less electricity, and costs drastically less to manufacture.
And Google has been refining the TPU architecture internally for over a decade. They utilize TPUs to train their own frontier models, proving the hardware is capable of handling the most demanding workloads on Earth.
But the structural shift occurred when the TPU transitioned from an internal Google asset to a commercial product available to external developers.
Yes, this shift triggered what we can call the TPU confession. The most prominent example involved Anthropic, the creators of the Claude AI models, and one of the fiercest rivals to OpenAI.
Anthropic signed a massive agreement committing to utilize up to 1 million Google TPUs. They executed one of the largest compute commitments in the history of the sector, completely bypassing NVIDIA hardware.
Meta executed a similar pivot. Mark Zuckerberg has famously purchased hundreds of thousands of NVIDIA GPUs. However, it was widely reported that Meta signed a multi-billion-dollar agreement to deploy Google's TPUs, while simultaneously advancing the deployment of their own internal MTIA chips within their data centers.
And when that specific news broke, NVIDIA's stock dropped several percentage points in a single session. The market instinctively recognized that the hyperscalers are actively engineering their way out of paying the 73% gross margin.
This introduces a massive analytical blind spot for the average investor.
Right, and I frame this through a Coke versus Pepsi analogy.
Let's hear it.
If I want to allocate capital to the Coca-Cola company, I can walk into a grocery store, purchase a can of Coke and a can of Pepsi, and literally taste the competitive difference. I have physical sensory benchmark to evaluate the product. I can assess the sweetness profile, the carbonation levels. I understand fundamentally why a consumer might prefer one over the other.
You possess the necessary context to evaluate the moat.
Exactly. But apply that exact same evaluation process to NVIDIA. If you place an NVIDIA chip, an Amazon Trainium chip, a Google TPU on a table in front of me, I have zero sensory or technical ability to evaluate the difference.
You feel absolutely nothing.
Nothing. I do not know how to code in CDA. I cannot quantify the latency bottlenecks between high bandwidth memory and the processing cores. I do not know if a TPU operating at a 20% slower clock speed, but priced 40% cheaper, offers better unit economics for a specific inference workload.
This is where analytical honesty becomes mandatory. If you cannot personally evaluate the technical and economic trade-offs between an ASIC and a general-purpose GPU, you cannot reliably answer the most critical, existential question regarding NVIDIA's future terminal value.
You cannot determine if the moat will hold.
Right. If you cannot answer that question, you are not engaging in investment analysis, you are guessing. You are outsourcing your conviction to whichever analyst sounds the most confident on financial television that morning.
Quick quote from Peter Lynch.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason.
Now, to maintain a balanced perspective, There is a specific demographic of investors for whom NVIDIA sits safely inside their circle of competence.
Sure. If you are a machine learning systems architect who deploys models across multi-cloud environments, you intimately understand the friction of switching costs. You know exactly what workloads a TPU excels at and where an NVIDIA chip remains dominant.
For those individuals, the investment is backed by genuine, hard-earned edge. But for the generalist investor, allocating capital without the ability to answer the custom silicon question means relying on borrowed conviction. And borrowed conviction rarely survives a prolonged 30% drawdown.
Never does. But let us assume for a moment that NVIDIA's engineering team remains flawless. Let us assume CV proves utterly invincible, end-user demand accelerates infinitely, and the hyperscalers abandon their custom silicon projects.
Even in that perfect scenario, there is a final catastrophic risk vector that has absolutely nothing to do with software architecture or margin compression.
We must objectively assess the geographic single point of failure embedded in the supply chain.
We mentioned earlier that NVIDIA operates on a fabless model, outsourcing the physical manufacturing of their chips entirely to TSMC.
TSMC fabricates nearly 90% of NVIDIA's most advanced accelerators, and the vast majority of those fabrication facilities are located on the island of Taiwan.
Now, we often hear the counterargument that TSMC is actively diversifying their manufacturing base by constructing new multi-billion-dollar fabs in Arizona and Germany.
While true, that narrative frequently ignores a massive physical bottleneck in the assembly process known as CoWoS.
Always spell that out.
CoWoS stands for Chip on Wafer on Substrate. To understand why it is a bottleneck, you have to understand a concept called the memory wall.
The memory wall, right.
In traditional computing, the processor and the memory chip sit on different parts of the motherboard. As processors became exponentially faster, the time and energy required to physically move data across the motherboard from the memory to the processor became the limiting factor for performance.
The data simply couldn't travel fast enough to keep the processor fed.
The solution to the memory wall is CoWoS packaging. Instead of placing the memory far away, TSMC physically glues stacks of high-bandwidth memory directly adjacent to the logic processor on a microscopic silicon interposer.
They stitch the components together with microscopic wiring, drastically reducing the physical distance the data must travel, maximizing speed, and minimizing power consumption.
It is arguably one of the most complex, high-precision engineering feats on the planet. And crucially, almost the entirety of TSMC's CoWoS packaging capacity is centralized in Taiwan.
This means that even if a raw silicon wafer is successfully printed in the new Arizona facility, it literally must be loaded onto a cargo plane, flown across the Pacific Ocean to Taiwan, undergo the specialized CoWoS packaging process, and then be flown back across the ocean to the customer.
The logistical fragility is staggering, but the geopolitical reality is what truly defines the risk profile.
And maintaining absolute neutrality and focusing strictly on risk management here. The diplomatic and military relationship between the United States, China, and Taiwan is historically complex and perpetually tense.
If any exogenous event occurs, a naval blockade, an escalation in military conflict, a catastrophic natural disaster in the Pacific, or even a sudden restrictive shift in international technology export treaties, the supply chain out of Taiwan could be severed.
And if that access is disrupted, NVIDIA loses the physical ability to deliver its product to the market almost overnight.
And there is no contingency plan that resolves the issue quickly. You cannot construct and calibrate a cutting-edge semiconductor fabrication and CoWoS packaging facility in 6 months.
It requires tens of billions of dollars in capital, immense localized power and water infrastructure, and a lead time of 5 to 10 years to achieve commercial scale.
The profound takeaway for an investor is that this specific risk vector cannot be modeled in a discounted cash flow spreadsheet. You cannot quantify the unpredictable maneuvers of global superpowers into a neat percentage.
The most severe threat to NVIDIA's valuation does not live within their SEC filings. It lives within geopolitical maps and international trade treaties. Evaluating that risk requires a skill set that sits far outside the standard financial toolkit.
So, we have meticulously mapped out a product that defies simple explanation: massive customers aggressively engineering hardware to destroy margins, highly concerning data regarding enterprise demand fatigue, and a geographic single point of failure sitting on a contested island.
With all of these massive compounding variables hovering over the company, how is the broader market pricing this equity?
The paradox that traps so many intelligent investors is that if you rely solely on traditional valuation math, the stock appears to be a screaming bargain.
We need to introduce the Lynch contradiction.
Let's bring Peter Lynch's favorite valuation shortcut into the analysis, the PEG ratio. Let's define the mechanics of that metric.
So the PEG ratio stands for price to earnings relative to growth. It is a mathematical tool designed to answer a specific question. Am I paying too high a premium for this company's future growth?
To calculate it, you begin with the standard PE ratio, the current price of the stock divided by its earnings per share. You then divide that PE multiple by the company's projected annual earnings growth rate.
So if a company is trading at a PE multiple of 20 and its earnings are expanding at a rate of 20% per year, you divide 20 by 20, resulting in a PEG ratio of 1.0.
Peter Lynch popularized the rule of thumb that a PEG ratio of exactly 1.0 indicates a stock is fairly valued. You are paying an appropriate multiple for the velocity of growth you are receiving.
If the PEG ratio climbs significantly above 1.0, the stock is becoming expensive relative to its growth trajectory.
However, if the PEG ratio drops well below 1.0, that is the territory where Lynch aggressively hunted for opportunities. A sub 1.0 PEG implies the market is fundamentally underpricing the company's growth engine.
Let's run NVIDIA's metrics through that exact formula as of mid-2026. The trailing PE ratio has actually compressed significantly, dropping down to approximately 31x earnings.
That is fascinating because the company's 5-year average PE multiple sits much higher, closer to 62x.
The multiple compressed violently because the underlying net income grew so massively that the rising stock price couldn't even maintain the historical ratio.
So you have a compressed PE multiple of roughly 31. But simultaneously, the consensus estimates for near-term earnings growth remain aggressively high, sitting at 65% or more.
When you execute the math, dividing a PE of 31 by a growth rate of 65, you arrive at an implied PEG ratio of less than 0.5.
It is drastically below the 1.0 threshold.
The pure, isolated mathematics scream that this stock is incredibly cheap.
If you look exclusively at the spreadsheet, it represents the exact statistical profile of an equity Peter Lynch would accumulate aggressively. A dominant, wildly profitable enterprise trading at a massive discount to its compounding growth rate.
But this introduces the critical contradiction that we absolutely cannot ignore.
The contradiction lies in Lynch's most fundamental, unyielding commandment of investing. Before you ever calculate a PEG ratio, before you even open a financial statement, Lynch demands, never buy what you cannot understand.
That optically cheap PEG ratio is a financial siren song. It appears incredibly tempting. But if you do not genuinely comprehend the causal mechanics of the business, if you cannot articulate the function of the CUDA software layer, or evaluate the unit economics of an inference API call versus a human employee, or assess the threat matrix of a custom Google TPU,
then buying the stock purely because the PEG ratio looks cheap is a direct violation of the first principle of value investing.
it is the ultimate value trap. Mathematical ratios only tell you what has already happened. They cannot predict what will happen next.
If enterprise demand fatigue forces the hyperscalers to reduce capital expenditures and NVIDIA's growth rate suddenly decelerates from 65% down to 15%, that cheap PE multiple of 31 instantly transforms into a wildly expensive valuation.
The math is only as reliable as the durability of the underlying business, and you cannot assess durability if you do not understand the product.
Which brings us to the final, critical exercise of this deep dive. We tease this in the introduction. We call it the mirror question.
I urge you to treat this mental exercise seriously. It is the most vital conceptual tool you can take away from our analysis today.
Stand in front of a mirror tonight. Imagine that you have allocated a massive portion of your life savings into NVIDIA stock. Now imagine that you wake up tomorrow morning, open your brokerage application, and see that the stock price has suffered a catastrophic 50% collapse. It has been cut exactly in half.
Look yourself directly in the eye and honestly ask, if this happened tomorrow, would I possess the conviction to know whether I should panic and liquidate the position or whether I should aggressively back up the truck and buy more?
That is the ultimate crucible of conviction. How do the different types of investors answer that question?
If you are an industry insider, a semiconductor systems architect, an AI researcher, or a supply chain analyst, if you understand the physical and economic mechanics of the business on a granular level, you can evaluate the news causing the drawdown rationally.
You can read the technical specifications of a competitor's new chip, recognize that the CUDA switching cost moat remains entirely intact, and confidently purchase more shares at a discount. You possess the behavioral advantage of a true owner of the business.
But what if your honest answer in the mirror is, I have absolutely no idea. I only bought it because the chart was trending upward and the financial media assured me it was the infrastructure of the future.
Then the deep discomfort you experience in that hypothetical moment is your definitive answer. You are not operating as an investor. You are operating as a hostage to the news cycle.
You will inevitably succumb to the panic, you will liquidate your position at the exact moment of maximum pessimism, and you will suffer a permanent loss of capital. If you cannot confidently answer the mirror question with informed conviction, you have no analytical basis for owning the equity.
As we conclude this deep dive, having explored the extreme boundaries of an ordinary investor's competence, I want to remind you of the analytical tools we provided at the outset.
We promised that we would not hand you a predefined conclusion regarding what NVIDIA is intrinsically worth. You have not heard a price target today. You have not heard a recommendation to buy, sell, or hold.
We have handed you the raw materials to construct your own conviction. Access the links in the description. Read the comprehensive brief. Open the interactive valuation tool. Input your own personal assumptions regarding the trajectory of AI demand, the margin impact of custom silicon competition, and the geopolitical risk premium.
Manipulate the variables and observe the intrinsic value that your specific model generates. The downloadable Excel file containing historical financial data back to 2010 is right there to ground your assumptions in reality.
Let me explicitly restate our structural disclaimer one final time. The entirety of this deep dive was conducted strictly for educational purposes and absolutely does not constitute financial or investment advice. We strongly advise that you conduct your own rigorous research or consult with a licensed professional before making any capital allocation decisions.
I will leave you with a final foundational thought regarding the mechanics of capital markets. Consider what the action of purchasing an equity actually represents. When you execute a trade on your brokerage platform, you are not merely placing a wager on a fluctuating green or red ticker symbol.
You are legally acquiring a fractional ownership stake in a physical operating enterprise. You are buying a proportional share of its fabrication contracts, its proprietary software code, its customer concentration vulnerabilities, and its immense geopolitical risk profile.
If you choose to participate in an arena where trillions of dollars of global capital are at stake and you do not possess the ability to read the technical rules of the game you are playing, are you genuinely engaged in investment analysis, or are you simply gambling inside an exceptionally expensive casino?
Wow, yeah. And looking ahead, you will not want to miss the target of our next deep dive. We are officially teasing episode 6 of our S&P 500 series, and the focus will be net FLAX.
This is going to be the exact structural mirror image of the analytical challenge we face today.
The contrast will be fascinating. If the defining friction of NVIDIA is that the product never interacts with the end consumer, Netflix represents the absolute opposite dynamic. It is the purest possible application of Peter Lynch's most famous philosophical mandate. Invest in the products you already know, understand, and utilize.
Consider the premise. Have you ever sat on your couch on a Friday evening, navigating the Netflix interface, realizing that virtually everyone in your social and professional circle is simultaneously engaged with the exact same platform, and thought, wow, everyone I know uses this. Can I actually own in this business?
Episode 6 is going to deploy the Lynch framework onto an enterprise you physically interact with every single day. We are going to rigorously test whether daily consumer familiarity actually breeds deep analytical understanding, or if it merely provides a dangerous illusion of safety.
Transitioning from the opaque physics of data center hardware to the highly visible economics of consumer subscription models will require a completely different analytical toolkit.
Ensure that you hit follow or subscribe on whichever platform you are utilizing right now so you do not miss Episode 6.
Take the time to look in the mirror, run the Visa test on your own portfolio, and we will see you on the next deep dive.
If you enjoyed today's analysis, make sure to follow the show on your favorite podcast app so you never miss an episode. As a reminder, this podcast is for informational and educational purposes only and does not provide financial, investment, or legal advice. Investing involves risk, and you should always do your own fundamental research and consult a qualified professional before making any financial decisions. Thanks for listening, and we'll see you next time.